the theme that we're going to be talking about today is not just what the blockchain is. That's just one part of it. But more importantly, where we're going with it. Okay? And the second part, which is where we're going with it, a lot of it is my own hypothesis. A lot of it is my own ideas. So you can hold me to it, but take it with a pinch of salt. So we're going to be covering three topics, essentially. The introduction, just so that we can get everyone up to the same level, you could say. Because I know there's a lot of people over here who probably know the blockchain better than me. They're being a bit shy, but I know who you are. Then essentially where we are today. What kind of position is the market in today? Who are the players? What's going on? And then finally where we're going, which is going to be the majority of the presentation. So just to put things into context and to give you an update, 2015 was definitely the year of the blockchain. Okay? We had over 120 startups in the Bitcoin and the blockchain space get created. Almost $1 billion was invested in VCs. And I'm really happy about this because in February, when I gave the first presentation at GEM, I was contacted by a newspaper called La Presse, which is based in Canada. And they actually asked me, they said, how much do you think people are going to invest in this? And I said, I think we should reach $1 billion by the end of the year. Thankfully, November 2015, CNN came out with a report in which they said $1 billion had been passed, so I'm in the clear for that. The R3 Consortium, which is essentially a group of different financial institutions and banks, along with partners from the blockchain space, have now become a rather big group. They're 42 banks. And if you don't know what the R3 Consortium is, I'll be talking about it later on. It's important to understand that this group of 42 banks coming together is something that's unprecedented to form such kind of a partnership. And it's happened in a very small scale of time, from August 2015 till today. NASDAQ has created NASDAQ Link, which is essentially a trading platform that uses the blockchain. For the moment, there's around 6 companies on it. Not all of them are financial companies. That's pretty interesting. I think around 3 of them are. And the first trade was actually done at the end of 2015. Microsoft has also jumped into the space, along with IBM and other tech companies, and they're now offering blockchain as a service. So like you have software as a service or PaaS or whatever, now you've got blockchain as a service as well. Deloitte has created Rubix. That's a place where you can go and develop applications based on the blockchain. It's pretty recent, very exciting site. If you've got some time, have a look at it. And then the BBC did a documentary on the blockchain right towards the end of the year as well. It's called Click. No, it's not called Click. It's on the platform called Click. And essentially, you're just seeing prototypes and a lot of innovation and different kinds of products which are coming out these days using the blockchain. So I guess the question that a lot of you are probably thinking about is, what's all the fuss about? Okay? And normally, when you give a presentation, you ask questions at the end. I like to ask a question right at the beginning. So just by a raise of hands, can you just tell me how many of you know how the blockchain works? So we have a relatively educated audience. I saw you. Okay? And that's great, because if everyone knew, then I'd have wasted at least 20 minutes of my slides. So what we're going to do is, it's for the rest of you who are not really too sure about it, is essentially come up to the same base. Like I said, it's very important to get the jargon. 20 years back when people spoke about the internet, they didn't really know what the @ symbol was. They didn't know how to call it. But today it's part of our vocabulary. If I say PaaS or SaaS, you know exactly what I'm talking about. It's the same thing with the blockchain. You need to get that vocabulary inside of you as well. So to give you some kind of historical context, I'll just start off with the internet. Now, the internet, when it was created by Windsurf and Robert Kahn, they created TCP/IP. And that's how the internet essentially functions. Turns out, if you want to send a message via the internet, it makes more sense if you take that message, chop it up into different kinds of blocks, and then zigzag it around via a distributed network. It's more efficient, it's faster, and that's why it's led to a whole amount of innovation based on that, like HTTP, SMTP, and VoIP. And that's essentially changed the way that we function today. It's also an environment, because of its decentralization and distribution, that is very, very innovative. And as a result of that, we had people like Tim Berners-Lee come up and create the World Wide Web, which essentially changed the world. But when we look at the financial system and the internet, we find that there's a very strange kind of dichotomy and still a certain amount of synergy. The financial system which you have over here is quite old. It's been there for a while. it's also very, very rigid. You've got the central banks who turn around and make an exchange with the government, and that's the way that capital gets introduced into the economy. The commercial banks then turn around and create money through fractional banking. So it's a very hierarchical kind of a system. It follows a certain kind of route. The internet, on the other hand, is completely different. Very flexible, very distributed, not the same kind of modus operandi as you would find with the financial system. But nonetheless, you can turn around and transfer value. And the way that you transfer value today is that you can use the internet to make a payment, but the bank is still in the middle of it. And they're the intermediary because they're turning around and saying that, you know what, this person has got 10 euros in his account, and yes, he can send the 5 euros to that other person over there, and we are verifying all of that. And the role that they play is very important because what it does is it avoids the problem of double spend. When you talk about double spend, think about it this way. If you have an email and you want to send the same email to someone else, you just copy paste it and then you send it away. Now, if you've got money which is digitized in the form of a code, then what's stopping you from just copying that same code and sending it away? It's very, very important that when you send money to someone else, it's no longer with you. And that role today is done by the banks. And they charge us quite a bit for it. Every transaction between 2 to 3% depends on what you're sending, where you're sending it. And we'll be talking a bit about remittances and stuff like that further down the line. So the solution to this was first seen with Bitcoin. And what Bitcoin turned around and actually said was, he said, we don't really need to use the same kind of a system. Let's think about it a different way. Why don't we create a currency or a money that exists only on this distributed network? It's native to the network. It's not outside of the network. Today you have money which is digitized, you can go with the ATM and you can take it out. Once it's in cash, it's actually in your hand. But with this, it doesn't work that way. So it only exists over there. And since it exists on the network, if you send it around, it doesn't really matter. Well, it matters to the person receiving it who's sending it, but it still stays within that network. And that's the first key thing. Because of its complete digital form, it allows you to have a greater amount of flexibility and a greater sense of security as to where the money actually is. The second thing which came up was they said, well, why do we still have to depend on the banks? There might be an alternative to the banks. And the alternative that they came up with was they said, let's use the people who are actually part of this network. Now, you have certain designated people who take on the responsibility of validating the transaction. So that's what essentially this whole Bitcoin and blockchain thing is all about. It's about these transactions which are happening, and when you're making these transactions, you're turning around and using the people who belong to the network to validate it, and in turn, they turn around and update a ledger. So the ledger is essentially what we're going to be talking about as we get further down the line, but it's this basic concept that's pretty important to understand, that you have a digitally native currency, and whenever it's getting transferred, the people who are turning around and actually doing the validation process is not some central authority, it's people who are distributed within the network, so different nodes can do the same job. So if there's no central point of failure, one node doesn't work, doesn't matter, there's another one over there. And these transactions are essentially the main thing that has to be taken into consideration. The transactions are essentially the backbone of the blockchain. Without the transactions, it wouldn't really function that well. And what's exactly happening is, when we talk about the blockchain, it's very important to understand what's a block. Okay, if you get what the block is, then the blockchain makes a lot more sense. And the block is essentially made up of different things. Obviously, made up of the transactions. When you make the transactions, it's like when you sign a check. You sign it and you send it to someone. You're doing the same thing when you're doing a transaction over here as well. The only difference is it's encrypted. And this encryption is represented in the form of a private key and the public key. These two keys is a lot like email and password. So when you need to send an email, well, you first need to log on, you need a password for it. It's kind of the same thing. You're turning around and signing this transaction, and you're saying, here's this electronic check, I'm sending it to this person. Once this transaction is actually put on the network, the people who have taken on the responsibility to validate it, they know that this transaction can only come from one source. That's because it's signed. These two keys, which I mentioned, they're mathematically linked. So you can't do this operation if you don't have the right password. And essentially, when they turn around and actually do the validation process, they're also doing some other things behind it in order to improve the validity of the transaction. That's where the cryptography of it comes into play. The cryptography of it is very important because it shows you the transparency and the reliability issues which are related with the blockchain. You've got to understand that a lot of the technical details which go into this, I'm not going to be talking about it right now because I already have covered that in a previous talk before. So what I'm trying to do right now is really vulgarize a lot of this stuff so it's easy to understand, because I know that there's different people from different audiences over here. So essentially try and get the gist of it in terms of what the actual function is. If you want to get into the more technical details as to how it works, I can do that as well, but we'll probably be here till tomorrow. So that's not the point. Okay. And then the final part is a very important part, which is the timestamp. Essentially, whenever the the transaction gets validated, it's happening at a certain time. And this time is really, really important. Because what happens is each and every transaction is linked in this kind of a sequence. And it's all of these transactions with all of this going on around over here that comprises the block. The timestamp is really important to underline because the point of time at which the last block was made is also linked to when this block is made. And that's essentially why it's called the blockchain. Because you have these block of transactions validated by time, linked to another one, and the one before it, and the one before it, and the one before it. That's where you get this integrity, because these transactions are immutable. Once they happen, because they happen at a certain point of time, you can't go back and change it. That's very important towards the whole security aspect of it. And because of the fact that they have this timestamp, if you want to change something, say you want to do the double spend that you hack inside and you get in over there, if you want to change the amount being sent from one address to the other address, you just don't have to change the address. You've got to change the time of the transaction, and the one before that, and the one before that, and all the transactions in the previous blocks. That's why it's got that integrity just through mathematical law. When the blockchain does a transaction, the validation is happening through cryptographic law, not through a rule or a regulation. Okay? So that's what the blockchain essentially is. It's this chain of blocks. And more importantly, it's this ledger. When these transaction happens, you've also got to validate it. And when you validate it, you put it on a ledger which exists on this network. The good thing about the system is everyone who's on this network has got access to this. They can go inside and they can look at all the transactions that have happened since the beginning right up to now. And because of the fact that it's distributed and it's very divisible, when I mean divisible, I mean that it can be shared between different kinds of people. That's what makes it something that's so revolutionary, because it goes against the silo kind of way that banking normally works. It's complete opposite, in fact. It's not a centralized system, it's completely decentralized. Now, this brings me to a topic which has been debated quite often, especially in the last year, which is permission ledgers. So right up to what we've seen until now is an open ledger. Now, some of you might be turning out and asking, well, maybe I don't want anyone who's on this network to turn around and just validate my transactions. I'd like to have someone who I can trust to be part of that validation process. And that's essentially what the permission ledger is. In a permission ledger, there's a kind of vetting process. So you know who the people are who are doing the validation. Probably wouldn't want to put the last guy in there, but I've heard he's very good with money, so I put him inside over there as well. And essentially, that's what a permission ledger is. It's a certain sense of exclusivity in terms of this validation process and the sharing of information. Banks are getting more and more interested in this today because it's something which is more in tune with their mindset. That certain sense of having a boundary around themselves. But they're realizing that if they want to really use this technology, then they have to change their mindset nonetheless. And that's what's really important, even with the permission ledger. Because when you look at the permission ledger, even though you might not be very comfortable with the idea of it going against what the blockchain was technically made to represent, which is this openness, it still offers a lot of advantages. Firstly, transactions can be created and they can be propagated by anyone who's in the node, anyone in the network, sorry. Everyone who's actually involved in it can converge on this, and they can get an identical copy about it. More importantly, you don't have a central authority that respects, that is doing the data ownership. And finally, the main advantage is it can control any fictitious entries because it's guided by mathematical law, as I mentioned. Today, we already have these in the banking system. but each thing is separated. What the blockchain is offering to all these financial institutions is to have a one-time solution to all of it. So even if you don't philosophically believe in the concept of permission ledgers, you've got to understand that it's much more than just a shared database. What it allows is a technological solution for which banks spend a lot of money in order to have that certain kind of symphony in terms of validating transactions and updating their databases. So I'm coming towards the end of my introductory part right now. And what I'm going to be talking about is with respect to permissioned blockchains, one of the companies that's actually involved in it. So I'm sure some of you have already heard about Ripple Labs. They're one of the first companies which took on a very formal kind of approach to implementing this technology. They just didn't turn around and say that, okay, fine, we'll follow the same open structure which is done by everyone else, like the Bitcoin protocol. They actually created something a lot more corporate, you could say, and started offering this technology as a service to different people. That's why I like this quote by Chris Larsen, who is the CEO of Ripple Labs, in which he says, we're not trying to go against the banks. We need the banks. We need to function with them. That's what we're here for. You disrupt your enemies, not your partners. So the final topic that I'm going to be covering in just this introductory part is the smart contracts. And this is where you're seeing a lot of innovation happening, because now it's not just a technical kind of a solution. It also allows you to innovate in different kinds of ways based on this technology. And what a smart contract essentially is a program. Input, output. You put in some information, it does something, then goes back to sleep. We have this already with HTTP. All your apps, everything works the same way. The only difference is over here that it lies on the blockchain. So the data that it's getting, the input data, that's transactional data, that's financial data. So this program essentially can transfer value. It can hold assets and it can transfer assets. And that's something that's very different. Your app can't really do that. It can allow you to do it. It's a facilitator. But this, on the other hand, is something that intrinsically has value, and it's coded to operate in a certain kind of a way. So just to give you an example to concretize it a little bit, say that I'm buying a house. You're the seller, I'm the buyer. You want to sell the house to me. Normally, what do? We use an escrow service. We turn around and we need the help of a lawyer to write all the deeds down, everything else. Instead of doing that, I can now program all of that process onto a smart contract. He's sleeping, he's lying on the blockchain. When it gets the input from me, that is, I have sent the money to you, it turns around and activates. What is it doing? It's transferring the deeds of the house to my name, and you get the money. Normally, to do this very simple procedure, we need a lot of intermediaries, a lot of middle people. With a smart contract, you can automate it. And it goes a lot further into this. If you really follow what smart contracts can do, people are now trying to automate companies with it. So technological unemployment, good days, huh? So this is just a couple of points that I wanted to put. I don't like putting slides with a lot of text, but sometimes it's really important to kind of highlight a few things. Essentially, I like to start with the last point, which is Ethereum is now becoming the next blockchain after the Bitcoin, in terms of size, because there's just so many people getting into it, creating different kinds of products. You can just look at the innovation that's going on in the Ethereum space. Really, really fascinating. And the reason that's happening is because what they've done is they created the first Turing complete language, which would work with this protocol. They didn't have that before. And that's what Ethereum did. They turned around and they actually created that. And that's the reason why they're really getting into it. They're not just limited to transactions. You can do anything, any kind of transaction which requires trust. So now you have a pretty good idea as to why people are getting, excited about all of this, and why you've got all these different kinds of articles coming out all the time. First of all, you have transactions now in which you don't require a middle person. You have complete legitimacy about the transactions. You have consensus on it. They're permanent. You manage to solve that double spend problem, which I mentioned before. No single point of failure, scalable pretty much to as many participants as you want. And more importantly, it can be used for just a whole variety of financial products and assets. Are we good to hear? Okay. Good, because now we're going to have some fun. We get into the part which is more interesting as to where we are. Now, the innovation over here has just been exploding for a long, long time. And the reason that the innovation has been exploding is quite simply because of the fact that the banking system today actually has a lot of problems. And one of the main problems that the banking system has today is in terms of mandated central clearing. This centralization which we have today, that process actually hasn't changed for 50, 60 years. It's pretty much been the same. Because of the fact that you have mandated clearing in which if a bank has a transaction with another bank or one financial institution with another one, it still has to go through a clearinghouse. And there are different clearinghouses who do this. There's SWIFT, there's DCCP, there's a bunch of them out there. And the way that it works is this process happens in batches. So when you do transactions, say you're on the stock market and you're buying stocks, milliseconds, nanoseconds even. But at the end of the day, just because you bought stock doesn't mean you spent the money. The ownership doesn't transfer to you completely yet because of the fact that the money will only be received by the other person in probably 2 or 3 days. That's what they call a T+1 to T+3. So it's a bit slow. And the reason that it's a bit slow is because of the fact that it's bunched up at the end of the day. And then all the transactions are sent by one clearing authority to the second one. And that's the reason why you have this time delay. So you've got this very weird kind of situation which you can make transactions and buy stocks in the capital markets at nanoseconds, but it still takes time in order to actually finish the transaction completely. The second problem that you also have with the banking system, and we saw this with the crisis, which is shadow banking. Banking that happens underneath the layer of the traditional banking system. A lot of this was actually seen with credit default swaps, CDOs, CDO squared, synthetic CDOs, all of that stuff which happened. That was innovation to a certain extent. I'm a critique of that, and I'll be talking about it right at the end of this little talk. But essentially, we have the shadow banking system. Yes, ma'am. Credit default swaps, sorry. Okay. Yeah. So, sorry, where was I? Kind of lost track of what I was saying. We can talk about questions at the end of it. Is that okay? Yeah. Shadow banking, right. Going back to shadow banking. And also because of the fact that after the crisis and because of all of these problems which happened with shadow banking, one of the problems that happened was banks started getting more and more regulations. Because they got more and more regulations, they had less liquidity. They didn't have the same amount of capital that they could use as they used to before, and that had adverse effects on the economy. Because of the fact that you can't spend the same amount of money in order to give loans to people, you have credit crunches, and if you have credit crunches, spending goes down, and then the economy actually starts slowing down. Another big problem with banks, and this is something which is in the news and out of the news very, very frequently these days, is the security aspect. All these transactions which are actually happening, they're not encrypted. Yes, they're covered by a firewall or maybe with a series of firewalls, but sometimes, and a lot of times actually, hackers can actually get through the firewall, and once they get through the firewall, all that information that's going on about the transactions, it's up there for grabs. So we have this huge data problem today. With the blockchain, on the other hand, you've got that encryption that's already within it. This is a good kind of solution towards that. Oops, sorry. So you've got all of these processes today which are also related to these transactions. KYC and AML, that's know your customer and anti-money laundering. This kind of vetting process costs banks quite a bit of money. There's processing costs, there's regulations which are to be respected in terms of recording and reporting. Reconciliation is another big factor, and of course then there's always the auditing. All of these are costs. Related to the tracking, related to the reconciliation, and of course the auditing. And to give you a figure so that you know how much all of these costs actually amount to, that's Stefan Thomas, who was giving a presentation, I think that's in September 2015, if I remember correctly. And that's essentially what he does. He works for Ripple, so obviously he's really involved in this space. And what he found was that 4% of all the wire transfers that we do actually fail. Most of them take over 2 days to go through. And the cost comes up to around 1.6 trillion. That's why Santander, which was one of the first banks that really started jumping into the R3 partnership, that's one of the first things that they found out. When they started analyzing, well, if we switch from the existing system to a blockchain-based system, 12 billion per annum. That's some change. Okay. So I find this very, very interesting because it transforms the kind of way that you look at a bank. And traditionally what you have as a bank is, it's got traditional networks, the SWIFT and all this transaction happening through these places. You've got a certain kind of approval system between the person who's actually making the purchase and the person who's actually buying something. And for all of this to happen, it takes between 1 to 3 days. But with the blockchain, you have a different kind of solution. First of all, when you make the transactions, they're not happening through these networks anymore. They're happening directly on the blockchain. The approval is done by the network. Okay? And finally, I've written 10 minutes over here, but it can be a lot faster than that. The reason I wrote 10 minutes is because in the Bitcoin blockchain, it takes 10 minutes to validate a transaction. If you use one of these private ones, like the Ethereum one or the Ripple one, it's a lot faster. It's actually in seconds. So you've got orders of magnitude kind of advantages in terms of that. Now I know sometimes it might be a bit confusing to kind of figure out, well, how does all of this work? And all of us are not finance people over here. So I made up this little flow chart in order to show you how this works today and how it's going to work with the blockchain. In the current financial system, what happens is, I'm going to use the example of trading a bond. Okay? So you've got a couple of counterparties who turn around and say that, okay, fine, I'm going to buy $100 million worth of bonds from you. Once the agreement is made, counterparty A informs his bank and sends the money to him. That person sends it to the B's bank, and once that happens, he reports it to the custodian. The custodian then contacts the other custodian, and finally, this transaction actually happens through the networks, through SWIFT. So DVP means delivery versus payment. So you only get it after you've paid for it. Okay. Now, if we move towards a digital way of doing it, well, we've got to change a few things, but we don't have to reinvent the wheel. We still got the same people involved. So you still got counterparty A, but what he's doing now is he's turning around and actually putting the money onto the ledger. So that's a certain kind of way in which you hedge your risk. You put the money in before so that you know that the other person's got what is required to make the transaction. So he tells it to his bank turns on and then puts that money directly on the blockchain ledger. Counterparty B does the same thing as well. He informs his bank, who informs the custodian. The custodian turns around and puts 100 million worth of bonds onto the blockchain. Once they do that, everyone's informed and the ledger is updated. Now the trade hasn't taken place yet. Okay, this is just prior to it. It's like prepping for it. When we do want to execute the trade, we don't have to depend on the traditional system. We can now do that with a smart contract, or in this case, what you could call a smart bond. So both the counterparties agree on the terms and conditions because that's what's going to be encoded into the bond. And when the time comes to make the transaction, the smart contract executes. Once it executes, the ledger is updated. And not just the ledger, but all the people who are involved in it as well get updated simultaneously as well. So you move away from the time lag which you had between 2 or 3 days for all of these people to get updated. That's where the problem is today. That's where you have back offices. That's what back offices do. A lot of what they do is just this verification process and making sure that, yes, all the money is inside over there and we've made this exchange. And it's because of these efficiencies of scale that all these banks have got so excited about it and come up and made a very dramatic name called the Distributed Ledger Group. The R3 partnership is essentially about that. Okay? And their objective, of course, is to come up with a standardization. Because if all of these banks are going to be using the same kind of process, the same kind of technology, then they've got to be speaking the same language. You can't have one using one own system and the other one using another system. Everyone's got to have some kind of uniformity, just like HTTP. Everyone uses HTTP. You can use it to create different things with different kinds of languages and software, but at the same time, it's that underlying protocol which doesn't change. That's what they're trying to create, a new kind of protocol, which is a standard everywhere. This comes from their website. Apparently, their 3 pillars are to make a financial grade ledger, a collaborative lab, and product development. That's kind of like 3 pillars on which they're trying to develop this partnership. And has it been a success? I would think so. It's definitely got people curious. As you can see, this image comes from CB Insights. And in the beginning of the year, there were just a couple of people playing around with it, not too many. And as time has gone by, you can see just in that one period from July right up to January 2015, it just exploded, more and more people. And I don't have the graph which goes after that, but that gets even more clustered over there. There's just been a number of banks that have joined into this partnership because they all want to explore avenues in order to make savings and also improve their security protocols, right up to the point that now they're up to 42 and they've actually had to close their doors. So I think this was in January 2016 that they turned around and said that, okay, fine, I think we need to stop a little bit because we've gotten a bit too big. Let's figure out, let's take a step back before we move forward again. So just to kind of wrap this section up, I'd like to go through some use cases so that you get some examples of what these banks are up to. What are they playing with this technology? And the first one is a number of them have entered partnerships with Ripple to provide cheaper transaction services in any currency. A lot of them are creating their own peer-to-peer trading platforms. So this example that I showed you about the bonds, that's like a good use case of that. And speaking of bonds, they're experimenting with different kinds of financial products. So that picture that you see over there, I stole that from Twitter. That's actually UBS turning around and making a transaction of a smart bond. That's a prototype that they're working on. Accelerator programs are just starting to abound. There's more and more people getting into partnerships with other companies because they don't really have that knowledge base within their existing infrastructure. And so what we're seeing today is there's more and more of these companies getting partnerships with existing financial traditional firms because it's just easier for them to scale that way. If they don't do that, then their competitors are going to do it, and you can't turn around and create that kind of knowledge base within your own system even in a year. Some of them are also playing around with making their own coins. This is a project which has been launched by a couple of banks just so that the people internally kind of understand how all of this works, and that can generate a different kind of innovation curve over there. And then, of course, they're also trying different kinds of encryption systems, such as NXT 3.2, Ethereum, of course, just a whole bunch of it out there. So there's a lot of innovation going on over here. You have to understand that there's been so much noise that's been made about this that everyone expects the products to be up and running right now. It's not going to happen that fast. You might have to wait right up to the end of 2016 in order to see some of this come up. It's a very complicated process. You're trying to literally change the rails on which the banking system actually works. So that one of the main things that I want to transmit as a message today is that yes, the blockchain is very important. It is changing a lot of things. But at the same time, you need to have a certain amount of patience because the implications, of course, are not just microeconomic, but macroeconomic as well. Banks are not the only people who are jumping in. They also got settlement houses. So like I mentioned, SWIFT, all those clearing houses. You've also got Earthport, which is another big one. Which settles a lot of transaction between themselves, between different counterparties. And they've partnered recently with Ripple, and they're using what Ripple calls RTGS, real-time gross settlement. So essentially, it can really save them a lot of time and effort, of course, in validating transactions. The advantages are pretty obvious. You can now have transactions settled in seconds. Your risk is something which you can work with because of the fact, like I showed you in the slide before, you put the money before, so you mitigate your risk that way. A lot of money gets held up today when transactions are actually taking because of this. When that money is actually held up, that's an opportunity cost. And because of the fact that your transaction is happening faster, the amount of time you're holding that money onto when it's not doing anything, that gets reduced. That's a big, big saving for them. Around 80% of the cost of a lot of these kind of transactions comes through this. So this is why it's a big deal for the banks, because it's not just the transaction. You send a message through SWIFT, it's going to cost you around $1. You do a Visa transaction, the transaction might only cost you 30 cents, but you have to spend $1 just to send a message to the other counterparty that yes, the transaction has to be done. So there's places where this can actually have big, big impacts. Of course, compliance friendly because it follows cryptographic law, and it's easy to adapt to. Like I mentioned, like you saw in the previous animation, we're not really reinventing everything. We're just changing the way that it actually works. The process generally stays the same. More importantly, and I think this is really the exciting part, you're not just focusing on finance and settlements. It's also the other places where you're seeing a lot of innovation. So you can see almost in any area today, and I'm not going to go through all of them because it's too much. But I really like the example of Everledger. So Everledger is actually for diamonds. And in the UK, they have a lot of problem with fraud for diamonds. So one person came up with the idea, well, if you can take a diamond and essentially you measure a diamond with the 4 C's, the carat, the color, the cut, and something else, and another C. I can't remember what the 4 C's are. I'm not a diamond expert. But essentially they said, well, you got this 4 C's, clarity, that's the last C, yeah. You've got these 4 C's with which you can actually turn around and verify a diamond, but there's also the way that the diamond is cut. You have data points, and what they found is on average, each diamond has got 40 unique data points. It's kind of like a fingerprint of a diamond. They said, well, why don't we take that information, make a serial number out of it, and write that serial number on the griddle of the diamond. Very, very small, of course. Essentially, when you digitize it, then you can put it on the blockchain. And now you can have a public and private key related to that. So every time that the diamond gets sold, you know exactly where it's come from. You can trace back that history of the diamond. And is this a big deal? Well, just in the UK, 65% of the fraud, 65% of fraudulent activities that is related to diamonds just goes unnoticed. It's a $2 billion. It costs insurance companies around $2 billion a year, just in the UK. So it's definitely got some advantages. That company is getting a lot of attention these days. There's other companies. Showcard is doing pretty much the same thing, but with your passport, your driving license, all your personal information. So they're trying to do the same thing. They're putting that stuff on the blockchain as well. So the next time you go, you want to travel somewhere, you take out your smartphone, you've got your key, your private key, lock into the blockchain, get your information out, show it. There's no way that anyone else could have had that, and off you go. So to finish up the part related to where we are, just some current developments, very interesting developments. IBM, Samsung, they're now trying to make an Internet of Things or applications which use the Internet of Things because of all the interconnectivity with the blockchain. So you've got all these different kinds of apps and things machines which literally talk to other machines. They can now transfer value between them as well. This is a pretty interesting concept which has come up recently with the blockchain and the connected car. Essentially, this company called DocuSign, what they're turning around and trying to do is improve the leasing process of how you can actually hire a car using the blockchain. Is it a big deal? When I saw this, I thought, oh, it's a pretty interesting idea. So what I did was I tried to figure out what's the market for connected cars. And I was quite surprised that just in the US alone in 2015, 40% of the cars that were shipped over there were connected cars. And that's just going to go more and more, in the future. So definitely a lot of potential over there. Philips, this is something which I find very exciting as well. Philips is getting into it. They're saying, why don't we use the blockchain to store medical records? You've got all this information that you can actually digitize and put on the blockchain. You can secure it. People don't have access to anyone else's data. They've got just access to their data. And what can we do with that is you can now, one of the ideas that I heard which was being circulated is that you can use it as an input to another kind of system like IBM Watson, which will analyze all of this. So just different ways of actually thinking about what people are doing with it. And finally, I think this is probably one of the most impactful kind of projects. There's this company called Banki-Moon. And what they're essentially doing is, there's a huge population in South Africa which doesn't have access to banks. And what they're saying is, well, it's okay, we'll provide you with a Bitcoin blockchain kind of a service in which you can pre-fund your electricity bill. The problem for a lot of these people is, even if they have money, they can't really use it because there's no bank for them to use it with. That's why M-Pesa became such a big thing in Africa. Now they're trying to do the same thing in terms of actually providing energy. And if you do any study in terms of gender inequality or just uplifting people from poverty, the first infrastructural aspect that they require is access to energy. So this is something that's really interesting as well. So as you can see, there's a lot going on, but it's not the end. This brings me to the part as to where we're going to go in the future with it. And I think this is the most important part to kind of analyze. And to do so, the first thing that I want to say is, let's cool it with the blockchain. There's been so much talk and so much hype about it that I think it's getting a bit out of proportion. And one of the fears that I have is that it might lead to the creation of, say, another dot-com bubble, just because of the fact that there's so much importance being given to it. Is it important? Of course it is. It's something which, as you've seen in the previous slides, is really changing the way people think about finance and what we can do with it. But at the same time, it's just a tool. And the magic is when you use this tool with other things which are going around, that really changes everything. So what I'd like to turn around and actually give as a caveat is that if you're going to look at the blockchain, please do, enjoy yourself, but develop a kind of peripheral vision and see what's going on in the other areas as well. Because I think the unison of these two technologies together, that's where the real impact's going to come from. We're seeing a lot of disruption in almost any sector of finance today. I mean, I started looking at, I've been looking at finance and seeing how different business models are changing over time. What I decided to do for this presentation is divide it into sections in terms of the sectors. The reason because of that, behind that is just because of the fact that fintech is getting so much advancement these days that it's getting harder and harder for banks to keep up. And as a result, what happens is a lot of these banks are now entering into partnerships. You're finding a lot of money getting put into the fintech industry just because of the fact that they realize that it's easier for them to actually use these applications. They work in partnerships with them. The fintech industry has been getting around it's been growing annually on average by 13.5% each year. 2015, 5 billion was invested in fintech, okay? And that's the reason that I think that fintech is essentially going to be finance. You're not going to find a difference between the two in the future. Platforms and data, that's essentially what's changing a lot of the way finance actually works today. And the impacts are everything from payments to lending, to capital markets, to investment management, and more importantly, to markets in general. Insurance comes onto this section as well. I wanted to include insurance as like the 6th point, but the insurance market is so huge that I need another talk just to get through it. So I've avoided you going into insurance over here, but trust me, that's another very, very interesting area. But in terms of this talk, I'm just going to focus on some of these. So we're going to go through these sections one by one really quickly, just so that you get an idea as to where we can go with this technology, not just the blockchain, but all of them at the same time as well. Now, as we've seen that there's quite a few limitations when it comes to payment systems. And when we look at payments, the first thing is, of course, the merchant adoption fees. When you use your card, your debit card or your credit card, the merchant who you use it with, like the shop where you go to, sometimes it's not very economically feasible for them to do it for you. There's high charges that are involved in it. Very simple example. You walk out of the school, you go up to a shop right around the school, and you say you want to buy something. And it's less than 10 euros, and you want to pay with your card. What's the first thing that the person says over there? He says, no, we don't accept the card for less than 10 euros or 15 euros. What's the reason behind that? It doesn't make sense to him. If he takes your card, then the amount of fees that he pays just for that transaction, he's not really making a profit out of it. That's why they always put those limits behind it. Micropayments are thus not really feasible. You can't make very, very small payments because of this. If you're underbanked, and this is a huge part of the world today, you might think that you're in a developed country, you've got a bank card in your pocket, so everyone else is pretty much the same. In my country of origin, in India, 50% of the world, 50% of the people over there are unbanked. We're 1.3 billion. So 50%, that's a big number. We can go to the US, developed country, right? 7 million. Fraud is also a big problem. And as we are moving into a more cashless kind of a world, these are big issues. So thankfully, there's been a lot of innovation in the payments industry by itself. And what I'm going to show you is stuff that's not really related to the blockchain at all. but more importantly, what's going on outside, which is changing the face of finance today. Mobile is having a huge, huge impact. Making payments with your mobile phone. These applications are really, really interesting because they offer you much more than just the ability to make a payment. Merchants can now turn around and have like special contracts with these providers because it makes more sense to them to use these guys because it's cheaper than using MasterCard or Visa. Okay? Biometrics is also changing the way that we identify ourselves. So the security concerns are changing as well. The solutions are being provided. These are just some of the examples of the companies that are involved in this space. And what they're offering us is simplicity. A much more simpler way, a much more cheaper way of making transactions, a lot of interoperability, your phone's connected to your computer. That kind of interoperability is coming from these tech firms, not from the banking firms. You'd think that if it's something related to transactions, that the bank should be coming up with it, but it's not. Apple, Android, Google, they're tech firms, right? And most importantly, what this is doing is, with these added services that they're providing you, they're changing the mindset of the consumer. We don't look at these companies the same way anymore. We expect more from them. I'll give you a very simple example. This is a personal anecdote. Uber, okay? I had a friend of mine who's in Paris, needed to go somewhere. Called up an Uber, the car comes up, he gets inside. As they take off, turns out the driver didn't know where to go. He didn't know where this place was. The GPS wasn't working, catastrophe. So finally they do get to wherever he has to go. They ask around, they get over there. When he gets out, my friend, being my friend, takes out his phone and goes on the app and he gives the guy a rating. So he doesn't give him 5 stars, he gives him like a 2.5. And in the comment section says, yeah, it didn't really work out too well because of this, but still a nice guy, so he gets 2.5. Very trivial, jovial kind of response. Of course, he was a bit irritated. An hour later, he gets an email from Uber saying that we saw your comment, we're really sorry that this happened. Normally, we expect our drivers to know about all of this. We're not going to turn around and do anything against him because it was a one-off kind of a situation, but we will reimburse you a certain part of the money that you spent for the trip. That is something that is amazing because what they did was they took a very bad situation and they made it good. And they were able to do that because they have, the technology which allows them to kind of analyze all of this stuff and not just analyze it, but pick the ones which are really bad and have someone respond to you personally doing that through an app which costs you nothing to download. Now, if they're doing that and our mindsets are going to change with the relationship to it, you'd think a financial institution should be doing the same thing as well. And that's why I like to call it the Uberization of finance, because that's kind of like where we're going with it, right? And all of this change has got nothing to do with the blockchain yet. And so that's why I want to see, like, if we take this kind of mindset change that's going on, then where are we going to go for it, right? And there's a couple of possible scenarios. So the first possible scenario that I like to think about is fragmentation. What we're going to have today is not just, in the future, probably is not just one credit card or one debit card, but you'll have a bunch of cards which offer you different kinds of solutions based on who you're transacting with. So they're still connected to your bank account, but you've got this whole kind of range of cards over there. This can also lead to the creation of new kinds of business opportunities. So there's a company out there which is called Walla.bi. And as you can see from the little icon, the little symbol, they effectively tell you, they're a kind of a consulting app, you could say, which card you should use with whom you're transacting, which one it makes more sense with. Should you use this one because it'll give you a cheaper price, or is there a benefit, you can come back and get a gift coupon, something like that. So it's actually something which people are using today. It already exists. The second scenario was probably in the future, we're not going to have any more credit cards. The clients will still be doing the same thing. But this time the pressure might come from the merchants. Like I mentioned, the merchants, when they make a transaction with Visa, it costs them. But when they make a transaction with MasterCard, it costs them another amount. And if you're using both Visa and MasterCard, then guess what? You've got to pay 2 fees for it. So probably what can happen is they can turn around and say that, listen, if you connect your bank account directly to the payments, because it's very cheap for them if they take the payment directly from a bank account, connect it to your Google Wallet, we'll give them loyalty programs, which will be transmitted back to you. You don't need to use a credit card anymore. So the banking industry, the commercial banking industry, is getting disrupted by Google. And because the people who are at the receiving end are sick and tired of paying high fees. So why don't we chuck blockchain into it, huh? Should be some fun. So if we turn around and put the blockchain into it, then essentially you've removed the bank from the equation. You don't really need the bank. You have a wallet. Your wallet is directly on the distributed ledger. People are doing the verification process over there. Your merchant doesn't have to have a loyalty program with even Google Wallet or anyone else. What they can do instead, and this is what they're already doing, is use IoT, the Internet of Things, mobile data, geolocalized data, essentially all this big data mining processes which happen today, and figure out what kind of best offer to give you. Your transaction happens directly between the two of them. You've got rid of all the middle people in between. And so the question then becomes, what are the banks going to do? And this is, I mean, I might be saying it in a very flippant kind of a tone, but I can honestly assure you there's a lot of people thinking about it today. I think the roles are going to change. I think the roles are going to change quite a bit. And it's going to be harder and harder for them to retain cash as well as reputation in this new kind of environment. That brings me to lending. So now we've seen the payment side, and the payment side is obviously changing because of so much innovation. The lending side is also changing as well. And that's happened a lot after the crisis, and rightly so. So we've had Basel III. Basel III has now changed the amount of capital requirements that banks need to have. That in turn has obviously limited access for investors, people who need to get money to do whatever they need to do. The process that is actually involved by banks today in order to figure out if you're a good person to lend money to is based on credit scores, which is based on past transactional history. There's a lot of research out there that shows that it doesn't really encapsulate the actual credit risk of the person. There's a high margin of error. It's obviously quite slow, customer service, forget about it, and low return and limited control. So what you have now is the rise of the alternative peer-to-peer funding platforms. And we've seen quite a bit of this. I mean, I'm sure all of you have heard about Kickstarter and all those different kinds of places. Essentially, it's making the money that a saver has, a lot more social, because now he doesn't have to depend on the traditional system of lending. He can go through a facilitator which exists on the internet. A lot of them use big data. They use different kinds of computing systems, algorithms. So their structures are very, very lean. And because of that, they can offer much more interesting kind of offers to their clients. The costs are a lot lower. And as a result of that, it's easier for them to get in contact with more and more people. At the same time, don't forget that just because you have a website, say you have a business, you got a website, technically anyone who's on the internet can visit your website, right? But currently only a quarter of those people can actually transact with you because Visa is not accepted everywhere. PayPal doesn't go to all the countries in the world. It goes to a lot of countries, but not to all the countries. Why? Bad credit rating. We're not going to go and offer you our services over there. You don't have the money to do it. This changes that. It democratizes the concept of finance. If you can use a system in which you're having just distributed ledgers and money coming in through that way without going through the traditional restrictions, you're increasing your client base by 300%. I like the last one as well. They use your social data now to come up with your credit score. So be sure that you've got the right kind of friends on Facebook. So this is actually an analysis that was done by World Economic Forum in which they kind of compare the two. You've got the traditional lending platforms in which you've got high risk seeking. There are people who actually want to invest in risky ventures. Alternative finance, alternative energy sources, for example. Maybe there's people who actually want to put money into it, but because the banks don't think that it's a good investment because there's too much leverage, because it's the success rate is going to be very, very low, or the payments are going to take too long, you're kind of bifurcating the entire process in terms of connecting people who need money and connecting people who are willing to give money. With the alternative platforms, it's different. You can now match people according to the risk that they want to take on. And I've just got a couple of examples of these companies because I think it's really interesting what some of them are doing. Anyone hear of Cabbage? Cabbage is known for the 6-minute loan. You're a small company, you need, $100,000 to get started, to hire people, to buy a piece of equipment. Normally, if you go to the bank, it's going to take you weeks. You've got to show all this paperwork, et cetera, et cetera. What Cabbage does is it data mines. It uses your eBay data. It uses the UPS data that you're transacting about. It looks at all the different kind of available information about you. And then what it turns around and does is it calculates a credit score and says, okay, based on this credit score, you're not going to get 100 grand, but you might get around 70. And it can do this in 6 minutes. LendingVest is essentially a peer-to-peer lending platform. This is such a funny story because they turned around and actually allowed people to turn around and get money from other lenders and other borrowers, connecting them together. What they found was that after a while, the banks were the people who were lending money because they realized that their own processes were so slow that they couldn't keep up with them, but they didn't want to lose the opportunity, so they turned around and put their own money inside over there, and they became the lenders. $1 billion valuation. Creditech is another new company. Creditech it's a German company. If you go on their website, the first phrase that you see is, banking is necessary, banks are not. And they do the same thing. They mine this information. They've got data algorithms who turn around and find out about this information and just find it very, very easy for you to find the amount of cash that you're looking for in funding. And Money Circle is the last one which I wanted to mention, is doing exactly the same thing as this, but using smart contracts. So now you've got a connection with this person who can give you the money. Well, we need to write a contract, right? Well, let's do it with a smart contract. So you're seeing the synergy of not just blockchain and smart contracts, but how it's working along with these other technologies as well. And the result is the same. Incumbents are forming partnerships with startups. So where's lending going? You're probably going to have a different kind of platform system in the future in which you've got people who don't want to take too much risk going through a traditional system, people who are looking for more risk going to alternative platforms, or maybe the two coming together. So it's still something in flux, but it's interesting to kind of watch. And if that changes, then what happens to the role of the bank? I think the question is, of course they need innovation, need to adapt to all of this, but what kind of innovation are we talking about? I think a decision needs to be made at a strategic level because these changes are not technological changes, they're strategic changes as to whether we invent in financial products, as we are doing with the smart bond and everything else, or if you're going to go towards customer experience. Because trying to do the same, it's not that they don't have the ambition to achieve it, it's just that how are they going to do it when you've got all this competition from tech firms coming inside. The final part of this section is with respect to raising capital. And it's pretty much the same kind of problems that we saw with the lending areas, right? SMEs it's harder for them to get money today. They have to go through a huge, long process in order to get that fund. And even if they get the funding, probably it's not even the amount that they want. Or if they bunch up with the VC, then they lose ownership. Alternative funding is now changing that. And it's essentially what we've seen right up to now, but looking from the perspective of the person who's actually receiving it. So in order to understand, let's look at the traditional system, and then we look at what's going to happen in the future. Today you've got investors, intermediaries, and opportunities. The investors are kind of segregated. You've got high worth investors who are normally the people who give money to seed ventures. And then you've got institutions and big populations of people. These people don't have the necessary capital requirements to make the investments. So what do? They go via the institution, and the institution then goes to private equity, venture capital, and finally that gets distributed to Series A, market makers, et cetera, et cetera. What can happen with these platforms is something very different. You've still got the same people, investors, opportunities, but this time it's a facilitator. I think it's important to kind of find the difference between those two words. And what they're going to be turning around and doing is they're going to be connecting not just the high worth people, but also the huge mass of people, which is people who have funds but not necessarily the right amount of capital. You go via an alternative platform, and then they are the ones who are doing the funding over here. This is actually what's happening today. And as a result of it, you've got this kind of segregation process that's happening with institutions in large areas which require a large amount of funding. So what the future of it could look like is a kind of combination of the two, in which you combine the mass which goes directly to the alternative platforms, and you've got the high net worth and the institutions going to the more traditional investment bank kind of structures. They're all turning around and putting investments in the same areas that we saw before. But more importantly, and I think this is something that's really interesting, is that they can turn around and actually fund local projects. Because a lot of the people who are in a certain kind of a population want to invest in their own kind of community. Today, that's not really the possibility because they don't have $100,000 lying around. They probably have $5,000 lying around, and they want to make that money social. They want to turn around and improve the community where they are. Now we have the opportunity to turn around and do that. And I find this the most interesting because it's connected to something which is being done by a professor in the school whose name is Mark Esposito. Anyone takes his classes over here? Mark Esposito's class, he talks about fast expanding markets. Okay, what is fast expanding markets? What he found through his research was we use the normal metrics like GDP, et cetera, that doesn't really allow us to get an idea as to what's going on within the microeconomy. There are pockets and clusters of innovation that happen within small places which create jobs, which create revenue, which are profitable. And today, because of the metrics that we use, we can't really get a look onto that. As a result of it, we're not really able to fund entrepreneurship at the micro level. And this is the reason why you have places like Paris and London where everyone kind of flocks together because they think that's where all the opportunities are. What happens because of that? Prices rise up, especially land prices. And that's very integral to what I'll be saying towards the conclusion, because land prices is related to inequality. So we have a technological platform today that can actually allow us as a solution to these kind of issues which we have today. The second last part is investment management. And this is probably one of the areas that has been impacted the most. Okay. The main reason for it is because of the crisis. After the crisis, there's been just so many changes that have happened over there, and more importantly, the organizational structure and the technical infrastructure isn't up to date. So the key technologies that are actually changing over here is, of course, blockchain and smart contracts, social networks, and most importantly, automatic wealth management. And automatic wealth management is essentially robo-advisors. Heard about these guys? Algorithms which actually turn around and do your money management for you. There's a bunch of companies doing it today. Wealthfront, for example, Betterment. And I went on Wealthfront site because I said, hey, I don't have 10,000 lying around, but I probably have a couple of thousand. I'd like to see if I can make some money out of it. Turns around that after I filled up the questionnaire, they're willing to accept my money, right up to the last point where I had to say which country I'm in. And I was in France, and they said, oh, sorry, we don't work in France. So I was very irritated, so I sent them an email, because that's the kind of guy I am. And I said, well, why can't I why can't I make an investment over here? And they said, well, just because of the regulatory rules that we have today, we can't accept money. You have to have like a US address if you want to make the investment. And one part of me was very irritated because of this, but then the Indian in me just jumped out and said, oh my God, that's a fantastic opportunity for a business over here. So these guys are turning around and actually using algorithms today to make not just a portfolio, but a personalized portfolio. Because as we saw on the other slide in which mass goes directly to the institutions, they don't really have a say as to where the money is being invested. Over here, you can create your own portfolio. And if you're making your own portfolio, probably you need the right kind of advice, investment advice. No problem. Now they're using social networks to do that as well. So you've got these kind of sites that have come up. StockTwits, Co-Investor, where essentially you can meet other market experts and exchange information about it. And that reduces a lot of these hype kind of cycles or bubbles that get created. A lot of people look at what the stock market is doing. They see one stock going up, they all start investing in it. Now you have the opportunity to kind of step back a little bit, talk to other people, manage your own portfolio in a different way, and automate it through the robo-advisor. And finally is algorithmic trading, which is really, really making a lot of impact today, because now you can go ahead and create these algorithms yourself, even if you don't have a lot of that technical kind of knowledge. They're making it very, very simple to create them by yourselves. And this is where I think blockchain and smart contracts are going to have the biggest amount of impact. Because if you're getting all this transactional data happening on a blockchain, private or whatever, and then you can automate the responses according to what the algorithm gives us as an output, then you can use the two together and create a different kind of a system. So these are just a couple of companies, Quantopian, AlgoFast, QuantConnect, all doing a lot of this stuff over here. If you need all these company names, come up to me after the talk and I'll give you my slides, no problem. Okay. So I like to call this investment management 2.0, and what's having a big impact today is advanced analytics. You've got the companies like ISADI, which essentially turns around and actually does trade execution strategies for you. So over here, what they're doing is they're looking at the number of people who make investments, they're making a cluster segmentation based on that, and they're giving it a risk value. This is normally what a lot of you get educated to do when you leave from here. You know, analyst jobs is to kind of do this. Well, now they have an algorithm doing it for you. Natural language processing is having a big impact as well. Kensho has created Warren. I don't know if anyone has heard of this. It uses natural language processing. You can turn around and ask Warren a question like, Petrobras, Financial Times today, oil prices have gone below $30 a barrel. What's the effect going to be on the commodities market? And it'll give you the answer. So investment management is essentially changing at different levels. You've got data collection, analysis, trade strategy, monitoring, and compliance. Those are like the main features of investment management. And for each and every one of them, you have now a technological company turning around and giving you some kind of a response to it. I think Red Kite is really interesting. It monitors the wrong kind of trading. And so that gives you an idea as to what's going on. And I think the one which made the biggest impact for me is fund apps. Compliance is an area where investment managers have to spend a huge amount of money today because it's harder and harder to keep up with the compliance rules which keeps changing. These guys turn around and offer that as a cloud-based management system. How do they do that? A regulatory compliance comes out, they change it into code, and now it can work with any of your data platforms because it exists in code form. They're even pushing now that compliance rules be published not as documents but as code. And in this kind of environment, the blockchain and smart contracts play such an interesting role. Because now if your regulations are changing and your trading strategy is changing according to that, you can turn around and to put a smart contract to perform certain kinds of actions based on that. So that's what is interesting about all of this. It's not just what's going on over here. Yes, this is very important. This is going to be the baseline, the place from where the information comes out and what kind of output you're going to have based on that. But in between, you've got all these different kinds of technologies which are changing at each strata of this sector, or transforming each strata of this sector. So the final part is, of course, the markets. If all the lending and the payments and investment management is changing, what effect is that going to have on the markets? Markets are already in a lot of trouble. Over the past few years, low volatility, liquidity constraints, trading infrastructure costs keep going up and up and up, and of course regulations which cost them a lot of money. The result has been high frequency trades, which were essentially considered, the gospel before the crisis. They've been losing a lot of popularity after the crisis. Straight after the crisis, right up to 2012, you can see the decline which has happened over there, and rightly so. So what are the markets going to do? And when I talk about markets, I'm talking about capital markets, stocks, equities, stuff like that. What's going to happen over here? Well, the data sources are still good. We can still get all that information. But what market these makers are doing these days is they're feeding it to an artificial intelligence. And this market artificial intelligence, because of the fact that it has neural nets and it can work on different kinds of probability scenarios, is doing a lot. It's coming up with hypotheses. It then turns around and makes the decisions based on that. It corrects itself. It learns. It sees what the result of the strategy was, and then because of the fact that it can learn by itself, it goes for better price discovery time after time after time. This is a company that's actually doing that. They use neural nets, genetic algorithms, in order to figure out what kind of strategies are actually going on. So NeuroDimensions offers a number of solutions. Trading solutions is just one of them. And essentially, I think that's the most important thing, because now you have a piece of software that can learn from the past mistakes and improve by itself. A lot of this is already being seen with Tesla. The Tesla car, how does that actually work? It analyzes the traffic situation and communicates it with other cars who've got the same software. So your car actually is getting an upgrade, even though it's not even moving or it's in a different part of the town. So to finish up this part, the key points for institutions today, in my opinion, isn't really, I still have quite a bit left actually, but you're not bored, are you? Okay, I probably have around 15 minutes left, so yeah. The key points today is essentially that 80% of this kind of digital transformation is related to strategy. The technology is just part of it, it's just a tool. A bank without a blockchain project can officially be called a laggard because they're not really keeping up with what's going on. But at the same time, it doesn't mean that just because everyone else is jumping into blockchain that you need to do it as well. Maybe what's required is to kind of step back, see exactly what you need. You probably don't need to have a blockchain solution. And the bottom line is we need to start looking at it from a much more realistic perspective in order to fix real world problems. Okay? So when you're looking at the blockchain, look at it with peripheral vision. See what's going on in the other areas. Find out how you can connect the dots. There's a whole bunch of technologies that are changing, but mainly it's the consumer who's changing. And I think that's the key factor. Okay. So this essentially brings me towards the end part of my little presentation. And this is more of the macroeconomic side of it. This is the research that I'm currently doing today. A lot of what I've shown you, I've already talked about some of these things before, but what I'm currently working upon is if we find that the role of the commercial bank is changing, then what does that actually mean? The relationship between the consumer and the commercial bank changes. In that case, what does that mean for the relationship between the commercial bank and the central bank? And I think that's a very important question to ask because what it gives us is an opportunity to probably look at economics from a very different perspective to kind of see if we can make more sense out of it. The way economics works today is essentially most of the theories that we hear is based on the efficient market hypothesis and the rational expectations theory. And according to this, economist turns around and says that, okay, fine, the economy is in a state of equilibrium. There are some people who will do good things, there'll be some people who will do bad things, but essentially they will equate each other because everyone's going to work in a certain amount of rationality. And because they work in that kind of rationality, we'll keep coming back to state of equilibrium. That's a dream, because we all know people don't actually work that way. We're not always making the most rational decisions. But it has been such an important part of economic theory that a lot of the economic models that have been made by people in the past have completely segregated the financial world. And the reason behind it is because they say that, well, the financial markets, they will function on these two theories, and effectively, if there's any prices that have to be found over there, it'll be found at the best price via this theory. And what's happened is over a period of time, especially since the 70s, economic theory has kind of diverged in its own way, and economists have said as long as we turn around and figure out how to control inflation with interest rates, we don't really care what's going on over there. That is the reason why people were not able to foresee the crisis, because of the separation between the two. And it's also led to other kinds of problems, like I mentioned, the inequality, the shadow banking, the price of land going up. All of this is related to that. And it's a big, big problem today. They also turned around and said that all the complexity that was going on within the financial market was a good thing. So you had people like Alan Greenspan, who came up in like 2004, 2005 and said things like the derivatives market and the financial innovation of creating credit default swaps and synthetic CDOs and all of those things. It's a very, very good thing because it allows for better price discovery, that allows for more flexible markets, and at the end it's a better allocation of resources. But the reality of it was something else. We had housing bubbles, shadow banking, increase in debt, and increase in inequality. Why? Because of the simple reason that banks work on fractional banking. Essentially what happened is you can trace this back to the 70s when the oil embargo hit, coincidence. And what happened was when that impacted Western countries. It really slowed down production. It turned down, it increased unemployment. And as a result of this, banks were given more abilities to create money, debt-based money, so that people could turn around and take a loan and they could still maintain a certain kind of lifestyle. You can see this in the figures. In the 50s and the 60s, the debt to income ratio was like 50%. And today, if you turn around and look at it, it's like 150%. There's been a huge jump in that. The second part of it is the people, when they take this money, they don't really invest it in, say, creating a new business, but they use it to buy something that already exists, which is land. And when they buy land, and you can read a lot of this with Danny Darling and Main and Sufi, they've written a book called House of Debt, which explains this beautifully. That's the reason why the price of land keeps growing. And what happens when the price of land keeps growing, you get a housing bubble, there's a lot of debt being supplied, a lot of credit being supplied, the housing bubble collapses because people start defaulting. When that stops, guess what? Credit supply stops as well, and then you enter a recession after the crisis. And this has happened repeatedly. This happened 6 times in the 70s. The most recent was actually in Japan in the 90s. And Japan is now in such a situation that it will probably never pay off its debt. So that's the main reason that we have this kind of dichotomy between the financial system and the way that it works and what the economists are doing in their own little world over there. And the goal for us today as an economy and as a society is to try and create a less credit-intensive growth model. Okay. So I'm going to be talking about a couple of ideas which unfortunately are not my own, but they've been controversial, and for a large part because of the fact that we've been operating in this kind of system, they've been excluded from the conversation in general for a while. And one of the things that people have spoken about, and when I say people, I'm talking about people like Hayek and Minsky, has said, why don't we turn around and actually create a different form of money, which is made by the government. And then we can give that money directly to the people, and that will help them out in a time of, they don't have the same kind of resources as they had before. That's essentially what's called a helicopter drop. And essentially what one of the economists said was, why don't we fly up over there and just chuck the money down and everyone gets it. We're not going to be doing that. But what you can give it as is probably as a tax cut, or you can just give credit people's bank accounts and they can get this money. The difference is it's not money that's created by the commercial banks. Fractional banking, you guys okay with that? Do you know what that is? No. Oh, okay. Fractional banking is essentially the way that money is created today. What happens is if you turn around and have 100 euros in your account and you deposit it somewhere, the bank which takes the money will turn around and keep 10% of it, and it can loan 90% of that. Now I come along and I want to buy something. I say, okay, fine, give me 90 euros, and I take those 90 euros. Now the bank has actually got an asset of 90 euros from something that didn't exist before, and I've got a liability of 90. Now from that asset of 90, they turn around and keep another 10%, so that's 9 euros, and then the 81, they get lent out again. And that's called the multiplier effect. So they can do this up to 10 times. That's what the Basel III regulation was. It said we need to limit that leverage which you get from it, rather than going from what it was, you need to get it down. And prior to the crisis, if you had $1, essentially it could be leveraged from 2 cents. So if you had 2 cents, you could give out $1 in loans. And what they've done with the Basel regulations is they said not 2 cents, but 10 cents. Now from the 10 cents, you can give $1 out of loans. That's what the fractional banking system is, and that's where the money is created. It's not, the central bank and the government exchange bonds, and the money is created that way. But the real production of money comes from there. Yes, please.
So how is money created in the blockchain credit or blockchain?
There's 2 ways to look at it. You can look at it from the point of view of the bit. Should I carry on and answer it later on? Okay, I can answer that in the Q&A. Is that okay? I have the answer for you, so don't worry. But essentially, this is what the helicopter drop does. Is it's a bit different. It says that why doesn't the government create its own money and not the way that the commercial bank does it? And if we give that money to the people, then you can have a different kind of a system. So one of the things that people are talking about today is the universal basic income. There's a couple of people talking about this, and this is essentially one interpretation of how you could use helicopter money. Germany, Finland, Sweden, I think another one, but yeah, these 3 for sure. They're launching universal basic income projects this year. So apart from what's going on the technological side, I would highly suggest that you have a look at what these guys are doing as well. Universal basic income has already been put in place a couple of times in the past. We're going to see it happen again in the future. And a lot of this actually stemmed from a conversation which I had with another professor over here who told me about Andy Haldane, who is the chief economist of the Bank of England, who said, why don't we move away from a cash system to a cashless system? And what this does is it allows policymakers a lot more flexibility in order to implement monetary policy. Today what you have is you have an inflation rate, and the inflation rate is governed by the interest rate. But if you put the interest rate down to, say, negative, below zero, what do people do? They don't want to get taxed on the money that they have, so they pull it out of the bank account. And so you can't really control the economy in the way that you want. But if you move to a cashless system, you can actually do that. And that's one of the ideas that are being played with today. And that's why I think the blockchain is essentially a stepping stone to achieving this kind of a goal. It's not just something that I'm thinking about, it's also the fact that there are countries who are actually trying to put it into place. So you've got Greece, who's now working with a number of people, number of tech people, trying to figure out if they can find a blockchain solution to them. Their economy is definitely in crisis, and what they're coming up with as an idea is, why don't we take all the assets that we own, make a token out of it, and use that as our currency. One of the problems for Greece is they can't get taxes. And if you can't get taxes, then you can't turn around and actually get out of austerity. But if you have a blockchain kind of a system, there's an answer to that. So this is one idea that's working about, that's going on. You can follow this person, Coinstructors, Lee Grant. He's really working on this subject quite a bit. And I think it's pretty important because when we see what's happening in terms of what's happening in China, what's happening in Brazil, is the blockchain the solution? Probably not. But if we can see how it's working with these other smaller countries, then probably we can get some kind of takeaways and adapt it to the problems that we face today. The last part of my slide pack is essentially we are seeing the signs of this actually happening because we're finding more and more congruence in terms of the structures. For all of this to actually occur, you need to have a certain kind of structure that allows for that capability. Very simple example, if you use your website today and you have a hyperlink, I can click on it and it'll go to another hyperlink, right? It'll go to another website. You can't do that with the monetary system today. You have this different currencies, different blockchains. So what they're turning around and doing is they're saying, let's create an interledger protocol. And this is from an article that was published last week on Wired magazine, in which you can have a universal protocol which allows each and every person to kind of communicate. And if you have something like that, then that's essentially where I think a government can use it, because you can make a base structure on top of which you can have one blockchain, two blockchain, millions of blockchains if you want, all of them working in their own way. This project is supported by the World Wide Web Consortium, which essentially controls the internet. So yeah, it's getting a lot of importance. And finally, if you need to turn around and actually use these kind of systems, then you also need a new way of measuring economics. So something that I'm reading quite a bit these days is complexity economics. And complexity economics works on the basis of the fact that you can simulate an economy. What they use is agent-based modeling, in which they have mini programs which represent key players within an economy. And what you can do is you can get all this transactional data, which is anyway digitized, and you can feed it to these programs who will then react in different kinds of ways, and you can program it. So a lot of these people who are over here, they're behavioral scientists, behavioral economists. Dirk Helbing, he is actually a particle physicist to become a social scientist. And essentially that's what he's doing today. He's using complex systems to govern different things like traffic. I mean, we use huge data farms to kind of see how the weather is going to change in the future, but we don't do the same thing in order to check our own economy. So this kind of a new form of economics is something that can really change the way that that happens. I've read 3 of these books. The third one is a bit too math-based for me. But if you want to get an idea as to this, you can definitely read Cesar Hidalgo's as an introductory. He just shows how connections work between different economies. and then you can move on to him, and finally with Dirk Helbing. So really, really important and exciting stuff going on over here. So that essentially brings me to the end of my presentation. I think I went over just by a little bit, no, not too much. I just wanted to say I was supposed to get copies of this book which my company has written recently. It's a white paper on everything about the blockchain. I think one of the first ones in French. Unfortunately, we had problems with the printer, but it's going to be published next week or so, so you'll be able to find it online. And essentially, this will give you an A to Z of what the blockchain is, how it actually functions, and also expert interviews and stuff like that. So that's pretty much my presentation. Be happy to take any questions if you've got any. I haven't forgotten you.